Financial statement analysis. Topic outcome. At the end of this topic, you should be able to perform financial statement analysis using relevant accounting ratios. Key financial statement. The first one is statement of profit or loss, statement of financial position, statement of cash flows, and statement of changes in equity. For this topic, we only focus on these two statements, which is statement of profit or loss and statement of financial position. This is the example of statement of financial position, which is the information consists of non-current assets, equity, non-current liabilities, and current liabilities. While statement of profit or loss, the information regarding the revenue and expenses of the company during the year. Financial ratio analysis, we have five classification of ratio. The first one is liquidity. Second one is efficiency or asset management. Next is leverage or debt management or gearing. Next is profitability. And finally is market ratios. First, liquidity. Liquidity, which is indicate the company position to meet its current obligation. There are two types of liquidity ratio. The first one is current ratio and the second one is acid test ratio. Current ratio, the formula is current asset divided by current liabilities. While acid test ratio, the formula is current asset, which is excluding closing stock and prepayment divided by current liabilities. Example of the calculations. The first one is current ratio. The formula is current asset divided by current liability. Based on this statement of financial position, current asset is 368,460. So this is the current asset and divided by the current liability. So the current liability here, which is 175,152. Then the answer is 2.1. So for every RM1 of current liabilities, the firm has RM2.1 of current asset. Next is acid test ratio. The formula is current asset excluding inventory and prepayment. In this example, we don't have prepayment, so current asset. Then we minus with the inventories, which is 368,460 is one, minus with inventory is one, 326,097 divided by current liability, which is from this figure. Take this figure, which is 175,152. Then we get the answer 0.24, which means for every RM1 of current liabilities, the firm has RM 0.24 of current asset. Possible causes for poor liquidation. The company holding too much stock, poor debt collection, or poor cash management, and etc. Suggestion to improve liquidity. We can promote cash sales, given cash discount, and etc. Next is asset efficiency or asset management. We have four types of ratio. Basically, efficiency indicates the effectiveness in assets utilization in generating revenue. The first formula is inventory turnover, which is cost of goods sold or cost of sales divided by average stock or closing stock. The formula for average stock is closing stock plus opening stock divided by 2. So opening stock, normally we get the information from the additional information. But if the information is not available, then we will use the formula closing stock. Next is average collection period. The formula is account receivable divided by credit sales. Fixed asset turnover. The formula is sales divided by non-current assets. Total asset turnover. The formula is sales divided by total asset. So total asset represented by current asset plus with non-current assets. The first ratio, which is inventory turnover, the formula is cost of sales divided by average stock or closing stock. So cost of sales, the information is 354,874 divided by average stock. Since there is no information on opening stock, then we use the formula closing stock, which is under current asset, which is 326,097. So we divide, then we get 1.09, which means the firm replaced its stock 1.09 times in a year. Next is average collection period. The formula is account receivable divided by credit sales. So account receivable 28,651. This one divided by credit sales. So since the information there is no credit or cash sales, so we assume that all are credit sales, which is 509,457. Then we multiply by 360 days, which is per year, because the answer should be in number of days. In this example, then we get 20 days, which means the firm takes 20 days to collect its debt from its account receivables. Next is fixed asset turnover. The formula is total sales divided by total non-current assets. So total sales is 509,457 divided by non-current asset, which is 18,517. Then we get 27.51, which means the firm generates RM27.51 of its sales from RM1 of its next fixed asset. Next is total asset turnover. The formula is sales divided by total asset. So sales is this figure. Then we identify the total asset, which is non-current asset plus with current asset, which is represented here with total asset 386,977. Then we get the answer 1.32, which means the firm generates RM 1.32 of its sales from RM1 of its total assets. Possible causes of efficiency problem: the company holding too much stock, or poor debt collection, poor cash management, underutilization fixed asset, and etc. Suggestion to improve: promote cash sales, given cash discount, introduce effective stock control system, pricing policy, and also credit term, and etc. Next is leverage or debt management or gearing. Basically, we have three types of ratio under leverage. Leverage indicates the financial stability and structure of the company. The formula for debt ratio is that total liability divided by total asset. Formula for debt to equity, which is total liabilities divided by equity. And finally, time interest earned. The formula is EBIT, which represent earning before interest and tax divided by interest expense. The first ratio is debt ratio. The formula is total liability divided by total asset, which is total liability, non-current liability plus with the current liability. So 28,694 plus with 175,152 for the total liability divide by total asset, which is 386,977. Then we get 0.5267. Then normally we represent in percentage. Then we multiply by 100. Then we get 52.67%, which indicate 52.67% of its assets are financed by debts. Debt to equity ratio, the formula is total liability divided by equity. So total liability, we just refer from the previous information, which is non-current liability plus with the current liability divided by equity. So equity 183,131. Then we get the answer 1.1131, which we multiply by 100, then we get 111.31%, which indicate 111.31% of debt used compared with total equity. Next is time interest earned. The formula is EBIT divided by interest expense. So EBIT, which represent as operating profit here, 54050, then divide by interest expense. So interest expense is 8345, then we get 6.548, which means the firm has 6.48 times of EBIT to cover its interest. Possible causes leverage problem include borrowing more than is necessary and suggestion to improve, adopt optimal capital structure.